When everything starts falling together, most people ask the wrong question. They ask, is this the crash? But that question doesn't protect money. The real question is, how do you position when fear is rising, correlations break, and the system stops behaving the way it's supposed to? Because in moments like this, wealth isn't lost in the market. It's lost in the response. In the last 24 hours, something unusual happened. Silver dropped more than 20%. Gold fell around 10%. Bitcoin and Ethereum were down double digits. At the same time, gold is still trading near $5,000 an ounce, and the US dollar is sitting at a multi-month low. When assets that usually protect you start falling together, it's not random volatility. It's stress in the system. This doesn't mean the world is ending tomorrow, but it does mean the financial system is under pressure, and investors need to think clearly instead of emotionally. For the first time in over 30 years, we're seeing a major divergence. People are extremely confident in the stock market, yet deeply pessimistic about their own financial future. That combination has only shown up before major economic resets. Since 2008, real personal income has consistently failed to meet its long-term growth trend, while asset prices have surged far ahead of the real economy. Stocks, housing, crypto, and even gold have grown much faster than wages. That gap cannot widen forever. What we're seeing now is not a sudden collapse. It's the system releasing pressure. At the same time, there's a bigger structural shift happening in the background. The US dollar has weakened, gold has crossed historic levels, and central banks have been increasing their gold holdings while reducing exposure to government bonds. This isn't panic. It's preparation. Reserve currencies don't disappear overnight. They lose credibility slowly, then suddenly. History shows this process takes years, not days, but markets begin adjusting long before headlines admit it. Sharp drops like the one we just saw usually happen during deleveraging. When liquidity tightens, everything sells off together. That happened in 2008. It happened in 2020. And it happens every time leverage unwinds. The mistake most investors make is reacting to that first shock. They sell quality assets because fear feels logical in the moment. They sit in cash waiting for clarity. And by the time clarity arrives, prices are already higher. The real danger right now is not volatility, it's fragility. So what should a rational investor do? First, avoid all or nothing decisions. This is not the time to go fully out of markets or to make extreme bets on collapse or euphoria. Second, reduce fragility. That means lowering leverage, avoiding forced selling, and making sure you can survive volatility without panic. Third, stay diversified across different outcomes. Own productive assets like businesses. Own real assets that hold value over time. Hold some monetary insurance like gold. And keep enough liquidity to take advantage of opportunities instead of fearing them. Fourth, stay systematic. Consistent investing beats perfect timing. History is very clear on this point. Crashes don't reward bravery. They reward discipline. Periods like this don't destroy wealth for prepared investors. They transfer wealth from emotional participants to patient ones. This moment doesn't require panic. It requires positioning. If you stay calm, diversified, and liquid, you don't need to predict the reset. You'll be ready for it, because volatility isn't the enemy. Reaction is.